Folks, welcome to the 2018 The Year Ahead Forecast. This is Bob Desmond, and a very happy new year to everybody. I wish everybody a prosperous new year, but more importantly, a very healthy one. So what we're going to do today is we're going to talk about some charts that are setting up and some predictions for the coming year. Now, what we're going to do is we're going to recap the 2017 The Year Ahead Forecast, and I'm going to enter some clips of what I had to say in 2017. They are edited, but you can always go back and take a look at the 2017 The Year Ahead Forecast in its full version, but I wanted to really skinny it down a bit and save some time. And that forecast is posted on the website. Now, for members, we're going to go into our strategy for the coming year on our The Year Ahead strategy session for 2018. That's coming out later today. And what I'm going to do is, after I go through these charts, I'm going to narrow down to 3 core positions that I want to put on in 2018. And one of them we've already begun to build upon. 2 we have not, but we'll be looking to start building fairly soon. So let's get to it. I'm going to begin where I began last year, and that's with a quarterly chart of the Dow Jones Industrial Average. And if you're sitting out there going, why is he talking about a quarterly chart? The reason is that it gives us the 100,000-foot view of the battlefield. Now, this time last year, we were right here. We had just bounced off of the lower band of the rising uptrend channel. We saw a little bit of selling that came in last year at the end of the year, and I had forecasted that we might see a correction early on in the year. And if I had to say what was one of my calls that did not pan out, that was the call for an early year correction, but overall a higher high on the year for the Dow Jones. So while short term we got that call wrong, longer term we got it right. And actually, here's what I had to say last year on the 2017 The Year Ahead Forecast with regard to the Dow Jones. We formed a rock solid base that began back in January of 14. It was retested back in January of 16. No doubt about it, a very strong base, which set the stage for this rally. But as it stands right now, the path of least resistance for the Dow Jones is higher. So overall, net on the year, we were bullish on the Dow Jones Industrial Average. We closed up 21.5% on the year. So a nice call. What's my call for the Dow Jones this coming year? I think that we move higher. I think we are very close to the psychologically important 25,000 level on the Dow Jones. We are going to hit it. Why? It's because traders are OCD. They need to touch a psychological resistance level or support level, and then they can move on from there. But I think we're going to 25,000 in a heartbeat. That's, I know it's not that far away, so no big call on my part. So I think that net, we are going to proceed higher early on in the year. The thing I see different this year with the Dow Jones versus last year is that we're heading into the year with RSI at 84.37. So we're fairly extended. We are trading considerably above the 2 standard deviation Bollinger Band in green. So we're a bit overbought. Volume in the final quarter rose. And with the holiday seasons that we had, meaning Thanksgiving, Christmas, New Year's, the abbreviated weeks, that's pretty significant that we rallied strong with good volume into the back half of the year. Yes, the final week was a bit weak, but it was the same last year as well, and we're still up 21.5% on the Dow Jones year over year. So net, I think we're moving higher in 2018 on the Dow Jones. I think that leadership is going to change, though. I'm going to talk more about that in a moment. The Dow Jones Industrial Average monthly chart, we are trading considerably above the 2 standard deviation Bollinger Band with RSI 87.45. So while you don't want to go dumping your shares of your Dow stocks tomorrow morning when the market opens, just be aware that we are overbought. I wouldn't be the least bit surprised to see a correction at any point. Why? It could be a geopolitical event, a black swan event. It could be North Korea. It could be a hedge fund that blows up. Who knows? But just be aware. I'm not predicting that we're going to go tanking, But we are due for a correction, and it's a healthy thing. We didn't get a correction in all of 2017. And while everybody's 401ks are looking rock solid if you were invested in stocks, it's also fairly thin ice as we proceed into the new year, because you need to have your consolidations like we had in the back half of 2016, and which set us up for a big move into 2017. So I think we're going to get that this year. I don't think we're going to have as parabolic a move higher in 2018 as we did in 2017. The Dow transports. Why do we care about the Dow transports? We want to make sure that the transports are validating the Dow Jones moving higher. And they are. The Dow Jones is at all-time highs. So is the transports. The path of least resistance appears to be higher. So net, it looks as though the transports want to move higher. One caveat here is volume is not looking good relative to the Dow Jones Industrial Average on the transports. So a bit of a warning flag being on the track, but not something truly to write home about just yet. No reason to go dumping your transport stocks. The yield curve. The yield curve in 2017 took a nosedive, and we are at the lows of the year. We closed out the year at the lows. That's a concern. The reason is that a declining yield curve is a precursor to recession. And if the Federal Reserve continues to raise rates, the correction in the yield curve may just speed up some. So this is a concern as we proceed into 2018. Now, is it by no stretch of the imagination reason to go selling stocks? Because history has shown on this chart here that a declining yield curve, you could still see the stock market head higher. It's only when we go into recession that you see the stock market correct dramatically. And overlaid here in blue line chart is the S&P 500. Take a moment and you could see that they do not trade in tandem. In fact, they, for the most part, trade inversely of one another. So as the yield curve drops, expect the stock market to head higher until, of course, it's a known that we are at the doorstep of recession. So when do we know if we have a recession on our doorsteps? Watch for that first month of a negative GDP, if and when we do get that. And if we get two back-to-back quarters of negative GDP, that is generally used as our guide for the economy being in recession. So 2-year yield curve, not looking good. No reason yet to go dumping stocks. But this is the bond market saying, you know what? There is reason to believe that the economy is heading towards a slowdown, if not recession. But it may not happen in 2018. The producer price index. Folks, last year I talked about inflation being the name of the game in 2017. We heard very little about it, yet inflation rose. This is the chart of the PPI, the producer price index, and it is breaking out. It is moving higher. We broke out of this declining downtrend line in mid to late 2016. In 2017, we really began to move higher. Now, the PPI, the producer price index, is the measure of inflation at the producer level. It doesn't necessarily mean that the consumer is picking up the tab for rising input costs, but it's only a matter of time before that occurs. Now, when you take a look at the CPI, you could see that in the first half of 2017, this is a monthly chart, we consolidated. So that breakout on the PPI in 2016 was not reflected in the CPI in the first half of 2017. Now, though, we are breaking out. We are moving higher on the CPIs. So now we're beginning to see in the back half of 2017 and into 2018, the producers begin to pass through those rising expenses to the consumer as reflected on this chart. This is not good for the consumer. Now, when you want to measure and you want to validate that there is inflation at the doorstep, you want to take a look at commodities. And commodities broke out. This is a weekly chart. They broke out in the last week of 2017. A clean breakout above this resistance level here. This is the GSG. Pull it up because it's clearly indicating on price and on RSI that it wants to move higher, on volume no less. How else are we measuring inflation? Look no further than the TIPS, the Treasury Inflation Protected Securities. This is a monthly chart. We have a breakout on RSI, a breakout on Stokes, no breakout yet on the monthly chart on price. But last month, for the month of December 2017, we flashed a bullish key reversal. And when you drill down to a weekly chart, last week we saw a breakout above this secondary resistance level at about, let's call it 114. Where do we close? 114.08. We did not close at the highs of the year, but we are very, very close. If we rally up and through 114.33 on a weekly basis and close there, that's a clear indicator to me that we have institutional investors buying TIPS to protect their portfolios from inflation. Now, what do the TIPS correlate to? What we just spoke about, the CPI. So keep an eye. Again, folks, I want to talk about this over and over again. Inflation is heating up. The government won't admit it because that means they need to pay out COLAs, cost of living increases on Social Security. That's the last thing they want to talk about. Why? It's because the government is broke. To pay those COLAs, they'll have to print more money. What'll happen if they print more money? More inflation. Lastly, to validate the fact that we are seeing rising inflation, I'm going to use the chart of the Pring Inflation Index. This is a measure of inflation and deflation. And you could see that last month, the month of December 2017, we broke out of a flag formation on the Pring's Inflation Index. We're putting in higher lows on stochastics, higher lows on RSI. We are breaking out. This is significant. So to recap our macro view of the economy as we proceed into 2018, we are seeing signs of inflation. We are seeing indications, as noted by the declining yield curve, that we have some red flags for the economy in 2018. Does that mean you go selling your stocks? No, it does not. It means that in all probability, you're going to see sector rotation. There are plenty of trades to put on here to profit from a rising interest rate environment. And again, we will be using 3 core positions, concentrated positions to outperform the market in 2018. And of course, we'll put on swing trades of other stocks and indexes that we see good opportunities as continuation breakout trades or extreme overbought or oversold type trades. But again, in 2018, I'm focusing on 3 core concentrated positions. Members, we're going to talk about what those positions are going to be during our strategy session coming out on our 2018 year ahead forecast strategy session. That's coming out later today. Healthcare, the XLV. I spoke about this in 2017, the year ahead forecast, and we were bullish on the XLV, assuming that we got our breakout, and we did. And we saw a rise of 21.77% on the XLV. And here's what I had to say last year. Healthcare. We are in a tight pennant formation. As it stands right now, I would not buy the healthcare sector. I would wait for a breakout above this upper band of resistance. We did see a head and shoulders setup, left shoulder, head, right shoulder. The neckline was broken, but we bounced off the lower band of support. So we're in a consolidation range. But what I will point out is that while we haven't broken out on price, stochastic is beginning to put in higher lows, as is RSI. Down volume is declining. So what do I think about the XLV moving forward into 2018? Well, the path of least resistance remains higher. Obviously, yes, we are a bit longer in the tooth than we were this time last year as we were consolidating. And we are seeing some warning flags on the track here. we have a divergence of the RSI moving lower with lower highs, yet prices have been moving higher. And in fact, we have a lower closing high on price. Stokes are moving lower, but we're not putting in lower lows. So to me, right now, the XLV is in a consolidation. The path of least resistance remains higher. It is certainly not a short. I'd be looking for a breakout as I was last year and trading healthcare long once again. Now, when do I become bearish? On a breakdown below this level here at 80 let's just call it 80. That was the prior low. If we begin to see lower highs and lower lows, then it's all over for XLV for at least the first half of 2018. Housing. In a rising interest rate environment, real estate does well. It's one of our watch areas for 2018. Housing should do well. Interest rates should stay historically low, but they probably will rise in 2018. So for the month of December, we had a doji star formation, a sign of indecision on the housing sector. I think we're going to set up for a consolidation here and then a continuation breakout higher in 2018. The U.S. dollar. Here's what I had to say about the U.S. dollar proceeding into 2017. Has reached resistance at 103.62. Last week, it flashed a bearish key reversal because I don't think that the rally in the dollar is going to last a lot longer. I think it's under threat right now because Donald Trump has made no secrets about his contempt for a strong U.S. dollar. He wants to bring manufacturing jobs back to the United States, and to compete with the Europeans and in particular the Asians, you need to have a weaker U.S. dollar. Okay, so fast forward, we did in fact have a very bearish 2017. We did not close at the lows of the year, but fairly close. We finished the back half of the year very low. Now, if inflation is in fact picking up, as I believe that it is, it's negative for the U.S. dollar. And a negative U.S. dollar is going to play significantly into our strategy for 2018. Because as inflation rises, the U.S. dollar grows weaker. So while, as I'm looking at this chart, the observation that I'm making is that the path of least resistance will remain to the downside in 2018. There's one fly in the ointment that concerns me, and that is the recently passed tax reform bill, which will allow for a lot of S&P 500 company earnings, which have been offshored for many years, to be repatriated. What will that mean for the U.S. dollar? It should be, at least in the short term, positive for the U.S. dollar. But net, the path of least resistance, I believe, is lower for the U.S. dollar. I think that politically, Donald Trump wants a weaker U.S. dollar to enable the United States to become more competitive in the manufacturing arena. So it makes sense that from a higher level view, the dollar should continue lower, which feeds into our inflation thesis and how we plan on positioning with our three core positions into 2018. The 10-year yield. Now, we had multiple rate hikes in 2017, but guess what? Yields closed down by 0.5% over 2016. Think about that. So what does that imply? It implies that we're seeing some economic weakness and that there is some anticipation, given some recent economic data, the Federal Reserve may not be as aggressive as they are forecasting. So we had a nice consolidation for the first half and into the second half of 2016, and we began to break out. I'm not going to be the least bit surprised to see a continuation breakout into 2018. And I am not necessarily predicting a recession in 2018, but if we do get one, you could bet your bottom dollar that the Federal Reserve is going to move in, and they will begin to print more money once again, dropping interest rates. But honestly, I think that's more of a 2019 story, not as much of a 2018 story. Let's talk about some sectors. that we're watching, the telecom sector, it had a very weak year in 2017. In 2016, it was our most favorite sector. I warned about the telecom sector moving into 2017, and sure enough, a big correction last year. Now, I think that this is a sector that could do well in 2018, but we need to close above $30.40 on a weekly basis. And we may consider opening up a position, but this is not one of our core positions that we're looking to put on. The semis, very extended. This is a monthly chart, very extended. While they may proceed higher into 2018, I do not think that they are going to be the leaders that they were. And if I'm right and we see inflation rise and interest rates rise, you're going to see sector rotation out of the semis and into commodities, real estate, consumer staples. We'll talk more about those charts in a moment. Technology, a leader last year. It still looks good, ex the semis. But again, much like the semis, they do not necessarily do well in a rising interest rate environment. I think that they will tend to underperform commodities in 2018. Consumer staples. This is one of my favorite sectors for 2018. It's a defense against inflation. We are very close to a breakout. We closed just shy of the lows of the year. We had a healthy consolidation for the past 18 months, and it looks as though we are poised for a breakout. So consumer staples, one of my favorite areas for 2018. The micro caps. All right, so with the tax reform plan, I expect that we see more entrepreneurship in the United States, I think that the micro caps will be the canary in the coal mine. You'll see growth in that area first. Because before you become a mid cap or a small cap or a large cap, you need to be a micro cap for the vast majority of businesses. So the micro caps are consolidating very nicely. We closed near the highs of the year. Not very overbought. I think there's a lot more room to the upside in 2018 for the micro caps. The XAU, which is the gold and silver index. Here's what I had to say during our 2017, the year ahead forecast. Now let's talk about gold and silver using the XAU. We bottomed out. I believe it's a bottom in the gold and silver market, unless the dollar does rip higher through that weekly resistance level I just went over. I plan on trading the NUGT. I already have a position in it. I'll be selling calls, selling puts, building a position further as we consolidate, bringing in premium, pretty much the exact same way as I did it last year. I think that President-elect Trump will make nice with Janet Yellen, who will remain accommodative to the market, and that's bullish. Now, if they step in... Okay, so during the past 2.25 years, from late 2015 to present day, we have been bullish on gold and silver. It's been a very volatile trade. We have made a tremendous amount of money, especially in 2016, in the gold mining names and in silver. 2017 proved to be a very volatile year, but it was a year of consolidation. So for our purposes today, we're going to review the monthly chart of the XAU. The XAU, and you're going to see a lot of bears talking about silver, gold on StockTwits, Twitter, because they just don't get the higher level view and the macroeconomic picture. Because if they did, they wouldn't be jawboning gold and silver down. They would be accumulating a position like we are. Because in August of 2017, the XAU broke out of a triangle formation. And what did it do for the remaining months of 2017? It retested the breakout point. So what does that mean? It means that what was resistance was retested not once, but several times, and it now is acting as support. And for the month of December, we flashed a bullish key reversal on the XAU. And in fact, Doug Cass of Seabreeze Partners, and who also writes for thestreet.com. We follow each other on Twitter. And in the back half of 2017, he became bullish on gold. He went long. And to his credit, he held on through that swoon in November, early December. And I replied with an observation of my chart of gold and the gold miners. And he retweeted that, giving the thumbs up. Now, Doug Cass is one of the few out there who I really respect as a trader. He called the bottom in 2008 within 2 days of the bottom. Really nice job. So we're setting up for a big move higher here in 2018 on silver and gold. And my favorite, the gold miners. Let's go to a chart of the gold miners. Let's use a chart of the GDXJ, the Van Eck Junior Gold Miners. You could see that the month of December was absolutely outstanding. While we broke down below this lower band of support on a triangle formation in November, and we had a rough early December, man, a bullish key reversal. This is one of my favorite charts, outstanding, looking gorgeous. Loving the gold mining names into 2018. As for the price of gold, outstanding. A bullish key reversal and, folks, a breakout on a monthly chart. This cannot be ignored. So would I go jumping in on Tuesday morning and loading up on gold, the gold mining names, silver? No. You need to leg in and build on strength. And what's most encouraging for me, besides the fact that we broke out of a triangle formation on a monthly chart in the month of December after flashing a bullish key reversal, is the fact that we closed above 1,300 on the year. Very, very significant. And we did so on volume. And this trade certainly feeds into our inflation trade. So watch the US dollar as it trades inversely of gold, the gold miners, silver, etc., and most commodities. The XLU, here's what I had to say last year about the XLU. XLU, overlaid here in black line chart, is the 10-year yield. Now, I've been speaking about this with members for several weeks. We have a divergence that is not supposed to happen. I call the utilities sector my canary in the coal mine for yields because utilities are capital intensive. They issue bonds and are perceived as being a higher risk than treasuries. So what do they need to do? They need to compete with treasuries on yield, and that adversely impacts their earnings. So as bond yields rise, utilities have to pay out higher yields, and that hurts their earnings. But what have yields done these past several weeks? Despite the fact that yields have risen, the utilities have rallied, and in fact, they have now broken out. This is a canary in the coal mine. If this continues, if we see a breakout, my guess is that, and it's a fairly safe guess, is that we will see yields break down once again, as I just mentioned on the 10-year yield earlier in this video. All right, so fast forward to December of 2017. We had a good year by and large, but for the month of December, we broke down. And you could see that the market was sending signals. And we were talking about this because the utilities are our canary in the coal mine for interest rates. And as rates began to rise, you saw some weakness in the utilities in the final month of the year. And the RSI was sending you a signal. It was putting in lower highs, yet the price of the utilities was moving higher. Volume, very high in the back half of the year on a monthly basis. So we're seeing some weakness on our indicators. If we get a breakout on the 10-year yield, it's my full expectation that you'll see some continuation weakness on the utilities in the first half of the year. And that's all I'm really willing to forecast on for the utilities. I think that longer term, our path of least resistance remains higher. And if we do see signs of inflation on the horizon, and if the Federal Reserve pauses on interest rates, you're going to see the utilities bounce back. So I'm going to punt here a little bit and only call a weak first half for the utilities. The second half, question mark. The banks. We have a significant breakout here. The banks are one of my favorite trades for the coming year. I know my first two favorite core positions I want to put on. The third spot is a toss-up. I haven't decided yet. I'll discuss that with members later on today. I'll make that final decision, and we'll have a fourth runner-up as well, just in case we don't get the breakouts that we're looking for. But as it stands right now, the banks I'm bullish on, and here's what I had to say last year about the banks. Now, the rally in the banks is for real, and I still think that we have more upside potential. We're probably going to go up to 25.40, retest the upper band of resistance, especially if Dodd-Frank is further repealed. They've already had a partial repeal on it going back to 2015, and I would expect under the Trump administration to see further deregulation of the financials, so they should do well. If yields do continue to rise, their NIM, their net interest margin, should do well as well. For that, I would look to the regional banks because they have more exposure to the mortgage market. All right, so we had a strong year. In the month of November, we broke out on the XLF to all-time highs. For the month of December, we pulled back, retested the breakout point, validating the breakout point. So the path of least resistance for the banks remains higher into 2018. If yields continue higher, the banks will continue higher. I like real estate. For real estate, you need mortgages. Watch your regional banks more so than your money center banks because their profits are derived more from NIM, net interest margin, which they realize on mortgages. Whereas your money center banks, while they make certainly a lot of profits from lending, they are overly dependent on trading, and that could be spotty. The XLY monthly chart, we broke out of a sound base. I like this sector moving into 2018. I think it'll do well. We closed near the highs of the year. It's not extended. Volume could have been a bit better. Volume was light, especially when you're breaking out of a sound base. You would have expected that volume would have risen, and it did not. So that's a bit of a concern to me. But net, the path of least resistance remains higher for the XLY. I think it remains along into 2018. Real estate, one of my favorites for 2018. Again, another recession play. One might argue that we broke out of this monthly chart in the month of December. Let's say this. Let's be conservative and say we closed at a breakout point, and it's very, very close to a buy. Not quite yet, but this is definitely one of my top 5 for 2018. We'll be watching for a new monthly high, therefore a new yearly high, year over year, and we'll be watching the 86.63 level as it is a new all-time high. If we break out above that level, you need to own the VNQ. So members, more to come on real estate. Again, folks, this is another inflation trade. If you believe there's inflation, you want to own commodities, you want to own real estate, you want to own consumer staples and the banks. And of course, you want to own energy. This is a monthly chart of energy. We broke out on a monthly basis above the upper band of resistance. A very strong breakout. Why did we break out? Look no further than oil. Oil closed, this is the USO, it closed above 12. It closed at the high of the year. So we're loving energy moving into 2018. And here's what I had to say about energy in my 2017, the year ahead forecast. Energy. I expect to see a continuation pullback on energy. Longer term, though, if the economy holds up, we may see higher highs, monthly chart. Take note of how bearish the energy sector was early on in the year due to the high yield bond crisis and the declining price of oil. Oil stabilized. OPEC has since gotten their act together. We bottomed out. Beautiful rally on the energy sector. We broke out in June, and it's been off to the races ever since. Bullish key reversal in November after retesting support. But last month, we flashed a doji star formation at the 2 standard deviation Bollinger Band in green. Does that mean it can't go higher? Of course not. It sure can. but my guess is with the sign of indecision, we're going to get a pullback and a retest of the breakout point. As far as I'm concerned, until we break this lower band of the rising uptrend channel, the energy rally is intact. But I will caution, volume dropped off in December. So energy, short term, somewhat bearish, longer term, still bullish. So you could see that we had a sound call on energy in 2017, a beautiful series of higher lows, and I think we're going to make higher highs into 2018. Members, we're going to talk more about energy on our 2018 strategy session. Again, coming out later today. Okay, the biotechs. We're going to leave off with this chart. I have a couple of members in our Facebook discussion group. If you're not currently a member, it's free. You can go join it. I'll link to it below in the video description section on YouTube. And if you watch this on the website, in the blog post itself, along with the video. So our Facebook discussion group members, Jerry and Kevin, they're looking to short the biotech sector. And while, yes, it had a rough October, we are seeing some consolidation here. And what I'd be looking for is this. Let's update the chart. Is a rally up and through this 45-degree resistance level, which would have us back above the prior lower band of support. Unfortunately, that lower band of support right now is acting as resistance. So I know what the weekly chart looks like. I know what the daily chart looks like. They look fairly weak, so I'd be fine if you're looking to trade it to the short side, short term. Longer term, though, I don't think it's a great short. I think that in all probability, we're going to see a move higher in the biotechs in 2018. And that's it, folks. Members, we're going to segue into the 2018 strategy session. We're going to discuss our 3 core positions, our concentrated positions for the year, and our 4th reserve position. And we'll discuss not only the monthly charts, but we'll drill down to entry points on a weekly, if not a daily basis as well. If you're not currently a member, you can get that commentary, even if you sign up for the bronze level membership. Our silver and gold level memberships, they will be closing tomorrow. So if you want to join, the silver or gold levels, you need to join by the end of business tomorrow. The bronze level is always open, so no rush there. And we'll have the strategy session posted for 2018 for all 3 bronze, silver, and gold level memberships. If you watch this on YouTube, give me a like, give me a follow. If you're watching this on the website, please enter your email address. You'll get best stock charts delivered to your inbox. We hate spam too. You will not be spammed. And if you're watching this on Stock, Twitch, or Twitter, give us a share and leave a comment, and I'll certainly get back to you. Everybody have a really great 2018. Thanks for spending time with me. Be well. The biotechs, which I would trade on a breakout, very similar to the XLV. I would not buy them yet. I would wait for a breakout above this upper band of resistance on this weekly chart.